Welcome to Fall into ETF Investing. On today's special episode, our panel of guest speakers will be discussing avoiding the yield trap.
Welcome to ETF Market Insights. I'm Erin Allen, and this is Danielle Nezel, and we're your hosts of ETF Market Insights. And today we're really excited to be kicking off our special edition Fall into ETF Investing.
Erin and I, we are out of our home offices. We're right here in studio together. We're also talking with experts in the industry. We're bringing everyone together to bring you, the do-it-yourself investor, a fantastic educational experience. Here at ETF Market Insights, we're all about providing DIY investors the tools they need to navigate these markets and manage their own investment portfolios.
Just a reminder before we do get started that we're not providing you investment advice or investment recommendations today. As Danielle mentioned, our show is all about providing education for DIY investors.
This episode is called Avoiding the Yield Trap. We are going to break down the due diligence a DIY investor needs to do when analyzing very high-yielding ETFs that come with an options portfolio.
And we're going to be turning over our hosting duties today to our special guest host, Jessica Morehouse from the More Money podcast. Jessica covers topics from personal finance to investing. Jessica, take it away.
Welcome to ETF Market Insights. I'm Jessica Morehouse from the More Money podcast, and today we're going to look at high-yield ETFs, specifically covered call ETFs, and get some insight on how investors should be analyzing these types of ETFs, given how much this segment of the market has been growing as of late, with many new ETFs being launched. It's important to know what to look for to find a yield you can trust. Now, joining me in this discussion is Andreas Rincon, Head of ETF Sales and Strategy at TD Securities. Andreas is a market maker in the ETF industry, and ETF investors might not realize how much we rely on market makers for ETF trading and liquidity. So thanks so much, Andreas, for being here today. We also have Richard Ho with us from BMO ETFs. Richard is focused on ETF sales and is especially passionate about options education, a topic we are going to get into shortly. Now, Andreas, let's start the conversation by setting the stage a little bit. Can you give us a quick intro to the covered call space in Canada?
For sure, and first and foremost, thank you for having me. It's really all about the need for yield in Canada. A population is getting older here in Canada, and because they're getting older, they want yield, they want more security, and covered calls is a great way to get that yield and security. Here in Canada, we don't have defined benefits, and as you grow older, you want something that is more secure. And covered calls is a great way to do that. You basically have a very good idea of what you're going to get on a monthly basis, and that's something that caters quite a bit to the older population here in Canada. So as the population grows and grows and grows, we get more and more interest in this space. Now, with interest rates higher, we have a lot of investors now on the younger side that are looking and saying, hey, you can also earn yield not just with fixed income, but also with covered calls. So it's been two-sided. So the older population looks at it from I need this yield, and the younger is like, well, this is very attractive in this current environment. You also have to look at it from the issuer's perspective. You can get yield in a variety of ways. You can get it via dividends, for example. Mm-hmm. You can get it via credit exposure, which is like a bond. But now what these issuers said is, well, why don't we get yield based on volatility? So basically what these products do is allow to capture some of the volatility and give it to the investor in the way of yield. So every portfolio will have a certain level of volatility. It actually is very smart in that it captures some of that volatility and it moves it onto yield and gives it to that investor. So that's something that we've seen that evolution over time, and it's really an innovation that we've had here in Canada.
Now, who are the players in this space? Can you kind of speak to those?
For sure, and there are many ETF issuers in Canada that have covered calls, and actually that lineup has been growing. The number of issuers has been growing. The number of products has been growing. We now have 134 covered call ETFs in Canada, which is a significant number, obviously. And we're now up to $20 billion, which is also a very significant number for the industry. Covered call ETFs alone represent about 5% of the ETF AUM in Canada, which is very significant when you compare it to 0.5% in the US. So covered calls are very, very important here. Now, there are several issues. As I mentioned, BMO is the leader here in Canada. They have over 50% of the AUM in covered calls here in Canada, and they have about 22 products, if I recall well. So they are definitely the leaders. And after that, you have the Harvest and CI and a couple other issuers in that space.
Now, what is popular among covered call ETFs right now? What are you seeing?
Before we go into the future and today, let's talk a little bit about the past. And the lineup of covered call ETFs earlier on really mimics what we saw in earlier days of ETFs, which was broad market, sector ETFs. In fact, the first covered call ETF in Canada, ZWB from BMO, was a bank covered call ETF. Early on, that's what we saw. We saw a lot of covered call ETFs on the sector side and the broad market. This was because that's what people knew, that's what they had. And early on, ETFs were known as purely passive vehicles, for example. But since then, we've seen a huge evolution. And now I would categorize it into, you have sector ETFs, you have region ETFs, you have broad market ETFs, and now you have a whole slew of new products coming in, including bond covered call ETFs, which I think are very exciting because obviously this is an area that hasn't really been covered by the space as much. And you also have what I call boosted ETFs, or slightly leveraged covered call ETFs.
Well, thank you, Andreas. Now moving on to Rich, you're our options education expert. Now with so many different options-based strategies in the market, how do investors know what to choose?
Well, first, Jessica, thank you for having me here. Much appreciated. Now, talking about the options market, when you take a look at these two option types, calls and puts, you can mix and match them, long, short, and what you can do is that you can generate and produce different option strategies. And with these combinations, you can generate over 30 plus different option strategies. But when it comes down to the most common ones in the ETF space, I would say that investors or fund managers and these manufacturers, they want to generate income. So one way to do so is by, for example, using a put right strategy. So a put right strategy is by simply selling put options on companies that you like to eventually buy, but you think that the valuations today is a bit too high. So that's one way of getting into the market. The other way of generating income is by using a covered call strategy. So in a covered call strategy, you basically have a basket of stocks, quality names, and then you sell call options to capture that income from these option premiums that you're collecting. So these are strategies, that investors who are seeking for income, for additional revenue, enhanced income, these covered call ETF strategies, put right option strategies, makes a lot of sense.
And to add to that, you also have strategies that do both, do calls and puts in the premium yield strategies such as ZPay. So
That's right.
you have, like you said, there's a variety of strategies that you can implement in this space.
Yeah.
Now, how does an investor analyze an options portfolio?
To analyze an option portfolio, I think the investor has to do some research about the fundamentals, about the securities, the underlying stock that the fund is going to be holding. It could be sector-based, it could be broad-based. So it depends on what the investor wants to have that exposure into, right? And then the other part that the investor has to look at would be the option moneyness. So an option moneyness is basically, okay, is the fund manager using at-the-money strikes or out-of-the-money strikes? Because at the end of the day, these strike price selections is going to have an impact on the performance and yield of those option-based ETFs. And most of the time, when we look at these ETF manufacturers, when it comes to generating additional income, they tend to stick with short-dated option expiries. The reason is because when you use options, you pay for time, and that goes into the time value component of the option pricing. So when you sell options, you want to sell short-dated options to take advantage of this, what we call that accelerated depreciation in time value. So that helps the position to, eliminate that time value in the fund manager's favor. So like that, they can write other call options or put options in the position to generate additional yield.
Well, thank you, Rich. And back to you, Andrea. So we're seeing leverage being used in addition to a call writing strategy to get higher yields for investors. Do you want to explain what is leverage? What is daily leverage?
For sure. And look, I mentioned it earlier, we have boosted ETFs now in Canada, which is a relatively new innovation here in Canada, where you add a little bit of leverage to an existing covered call ETF. And the idea here is really to get more yield. But obviously with more yield, you get more volatility and more risk out of these products. Generally speaking, what we're seeing is about a quarter of leverage. So 25% more leverage. Some of them have 33%, but they generally cap at that level. The idea is not really to add volatility or add a lot of leverage to your portfolio, just really to boost that yield, as I was mentioning boosted ETFs earlier. So the yield is a little bit higher, of course, but also the volatility of the portfolio is a little bit higher. So it's important for investors to be cognizant of that added volatility that you're having when you're buying this higher yielding product.
Maybe I'll add to that. Like when I did some research about these leverage covered call ETFs, you have to remember that a covered call strategy, you want to deleverage, you want to reduce risk. That's why you're taking your shares, the stocks that you have, and you're selling calls. And by selling calls, you're selling delta. And that delta is going to reduce your delta risk in your portfolio. But if you're using a leverage covered call strategy, always remember, like on the upside, you're going to be capped because you're selling call options. So your upside is capped. You're taking on maybe more risk at the end of the day because you still have that downside risk exposure with the stock position that you're holding.
Thank you so much for that, Rich. Andreas, what are the risks involved with leverage?
And Rich mentioned one of them, like when you add leverage, you automatically add more volatility to the portfolio. And he's right. When you're generally, as an investor, when you buy a covered call, you're looking to reduce your volatility because when you sell a call, you're actually reducing the volatility of your portfolio. You add leverage, you kind of offset a little bit of that, to be honest. So one of the risks is that you're increasing the potential for a drawdown in your portfolio at the end of the day, because if you're at a little bit more leverage, that drawdown might be more significant in a downturn, let's say. And if you are an older investor, you want to limit your drawdowns because it takes you a long time to recover from those drawdowns. So given you don't have unlimited time, let's say, reducing those drawdowns is significant. It's very important. So that's one of the key risks. The other key risk here is really about the performance of these ETFs. And you mentioned it earlier, it's daily leverage. So what's important about daily leverage, and it's important for investors to understand this, most hedge funds strategies, let's say, will have leverage 2-3 times, let's say. This is daily leverage. What this means is that this leverage is reset every single day. And there is a target that you're gonna have this 25% leverage every single day. Now, what this does actually is that makes the ETF a little bit path dependent. Now, this is fairly significant on a 2 or 3 times ETFs, let's say. Not as significant on these ETFs, but still important. So what it will mean is that the performance of the ETF will definitely depend on the volatility and in the direction of the ETF.
Can you give me an example?
For sure. I mean, easy example is that you buy an ETF today, then that ETF falls 50% the next day, and then 50% goes up the next day. You're not back to zero. You're actually down 25% just over 2 days. And if you compound that over time with daily leverage, that actually augments the performance of the ETF and impacts it quite a bit. So that's something you have to be cognizant about when you're buying these boosted ETFs, that they are slightly path dependent to some degree. And obviously they add volatility to your portfolio.
And we talked a lot about risk. Can we talk about cost? What's the cost of leverage?
Yeah, so when you actually add leverage to a portfolio, leverage is not free. You need to borrow that from somewhere. And these ETFs actually borrow it from the banks. So they borrow money from the banks to add leverage to that fund. And that cost of leverage actually increases with interest rates. And we all know interest rates have been going up over the last few years. So because of that, we've seen the cost of leverage increase so slightly. Now, obviously, as I mentioned, it's just a small turn of leverage that they use, but that has been shown now a little bit on the total cost of ownership of these ETFs. So, when you look at an ETF, you look at the management fee, but the total cost of ownership is really the MER. And you can see in some of these ETFs a little bit more elevated than the management fee.
I may add to that. The fact that it's using leverage, when you take a look at the ETF facts, the risk rating, because it's leverage, is going to be rated as medium to high for something as conservative as a covered call strategy on Canadian banks. And when you do not use leverage, for example, ZWB, which is the covered call ETF on Canadian banks, the risk rating in the ETF facts right now is medium. And just like my friend Andrea said, like the MERs would be significantly higher because the fact of using leverage. And again, if you look at the ETF fact sheet or ETF facts, you're going to see that the MERs could be at least 50% higher than an ETF that does not use leverage.
Thank you so much, Rich. And now, what are some considerations that investors should have when they are comparing these high-yielding ETFs?
That's a good question, Jessica. Well, since the theme of the session is about yield traps, let's talk about yield. How do you calculate that yield, right? To calculate the yield, you simply take the price of the stock and you divide, with the ratio versus, depending on how much distribution is being given back to investors. Now, for example, if you take a company that pays you $1 dividend and the stock price is $10, that yield is 10%, right? But let's say if the stock price goes from $10 down to $5, a 50% drop, great. The yield, when you do the math again, is showing you 20% yield. So for investors, not knowing what happened to the stock price, that it came down from 10 to 5, they'll be like, hey, this 20% yield is amazing. So these are the traps that you have to be aware of, that you have to do proper due diligence. And when we bring that concept back to a covered call space in ETFs, sometimes when you see the yields, yielding double-digit yields, you have to see how are they able to produce that yield? Because there are two sources from these strategies. One is coming from dividends. Two is coming from option premiums, right? You cannot make that up. And so when you look at these different, yielding, income generating strategies, take a look under the hood and make sure that you don't fall into some of these traps. I'll give you an example. Like, as you know, the NASDAQ index did phenomenally well this year. NASDAQ is up, I would say, 36% year to date at the time of this recording. And we also have a covered call ETF on that, on NASDAQ names, on tech names, okay? Ticker symbol ZWT. That covered call on tech names came in year to date with about 38% return year to date, which is great. And as you know, like these tech companies, they don't tend to distribute any dividends. That's their business model. That's what they do. They take that, gain revenue and invest back into R&D. So in a covered call strategy on tech names, we're able to simulate that type of dividend payouts by using the options market, right? And now, all this being said, I just want to, highlight one of the covered call ETFs on NASDAQ 100 in the States. I think the ticker is QYLD, if I'm not mistaken. Take a look at that product. That product is a covered call strategy, and it's advertising about 12% yield, which is great. 12%. I would buy it too. But if I take a look at the chart, year to date, QYLD is just up by a bit north of 5%, 6%. So why is the NASDAQ going up 35% year to date, and this covered call ETF is only up 6%? So even though you're getting a 12% yield, you have to be sure that you're not taking that for short-term gains and missing out on long-term rewards.
Thanks, Rich. Now, what about the underlying portfolio of stocks? What are some considerations when analyzing this part of a portfolio?
I think considering the underlying stocks is very important, because when you think about a covered call strategy, it's like you're buying a portfolio of different names. You have to make sure that those names are good, right? It's buying real estate property investment. You want to buy a duplex or block of building that is in a good neighborhood that's able to collect, fetch that rental income that you're expecting to get, right? So in a covered call strategy, you're buying these different companies and you're renting out those shares on a monthly basis to collect additional income. So when it comes to, for example, the investor taking a look at this space, saying like, I love, that diversification, that reduce in risk from a covered call strategy, you have to decide next what sector or what broad-based index or market that you want to get that exposure in. For example, if the investor prefers to have names in Canadian bank stocks, right? You can buy the bank stocks. That's going to generate maybe 5% yield or whatnot. But if you like that and you need that additional income, you can overlay an option strategy to it and get an extra 3%, I would say, which is not bad.
Yeah.
Getting 8% on quality names like Canadian banks will help lots of retirees supplement that month end for expenses and so on. So these strategies, you have lots of options in there. You can decide on the sector. You can be very sector specific, or you can go broad based in US, Canada, international.
And actually, BMO is very well known in terms of the lineup for their high dividend strategies. So a lot of the ETFs in covered call land are already high dividend space. For example, like the utilities, the banks are very popular with BMO. So obviously, you just tag on more yield to those strategies that many Canadians already own today.
Yeah, that's right. So one of the methodologies that we at BMO employ is that we screen through the securities market, and we identify the ones that pay out a stable, reliable dividend stream of dividend income, and we take those names and we sell calls on them, and we tack on more distribution, better yield, and names that investors like and buy.
Amazing. Well, so much great information. Thank you so much, Rich. Thank you so much, Andreas. And thank you for joining us. It's so important for investors to have the tools and education to evaluate higher yielding ETFs like covered call ETFs. And just because an ETF has a really high yield doesn't always mean it will be suitable for you. So great information today. Thanks so much to ETF Market Insights for hosting this great discussion and their commitment to educating DIY investors. Thanks to everyone for tuning in, and we'll see you next time.